Portfolio Builder members, welcome to our Tuesday Trade Alert where we generate income from the Emerging Markets ETF. We'll jump into today's Trade Alert in a second, but for new viewers, a quick little piece about who we are and what we do. Daily income trade alerts at noon Eastern. Here's our current trading schedule and allocation per asset class. 54% is currently in equities, 38% in bonds, 8% in gold with a target income of $750 per month per $75,000 invested. Many of our members are millionaires, so just multiply it and get to the total asset you want to invest into this strategy. Currently, we have a pretty easy to remember ratio. For every 100 shares of the SPY, you're going to have 200 shares of emerging markets to trade on Tuesday, 200 shares of the TLT ETF, which generated a large profit so far today. That's your 20-year plus Treasury ETF, traded on Thursday, and then another 200 shares in the Gold Miner ETF GDX, also traded on Thursday. Now, the SPY ETF is really our bread and butter play, which we trade Monday, Wednesday, and Friday, taking advantage of the most liquid ETF in the world with the only 3 option expirations per week. Every other ETF is either weekly or monthly, but the SPY ETF lets us sell and buy options every Monday, Wednesday, and Friday, making it an excellent strategy for generating income. And so our target return is 1%, but so far our average has been 1.35. More importantly, we've never had a loss greater than 1% in a single month. And in fact, we've only had one single month where we lost money. In a 90-day stretch, we've never had a loss. And we do have a free educational webinar every Thursday at 2 Eastern. In the description box, you can get a link to sign up for it. It's free and it's reoccurring. It's not a big sales pitch. It's actually an hour and a half of our $10,000 bootcamp program, Module 1, where I teach you the big picture and how our strategy works in detail. And so if we look at the S&P 500, you can see we've been able to generate consistent returns regardless of what the stock market's done. In December, your portfolio held on to a 18% drawdown, while our portfolio generated a 1% return. And what I'll challenge you is to ask yourself, what's your risk to reward ratio? What's your greatest drawdown versus your return? Because that's much more important than your total return. Because you never know when some of these sell-offs might get escalated and turn into a panic, like we've seen in 2008 and 2000, just to recall the last 2 major market corrections. And also point out in May, stocks fell almost 7.5%. We made 2.2%. And in August, when the market suddenly sold off because of trade war threats, which was just a month after they told us we had a trade deal, everything's coming around circle again right now. We generated a nice profit when the S&P 500 again sold off 6%. This portfolio is rock solid and it's extremely hard to lose money. Our simple 4 ETF portfolio is extremely diversified and all you'll need for your retirement. Income and safety, not growth or speculation. Simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. So if you're new and you want to sign up, call Dean to reserve your spot today at 505-322-7515, and you can save 40% on our annual membership. Okay, there's our disclaimer. If you want to read it, you can pause the video. Let's jump into today's trade alert. Okay, so we've got a new video cover at the top of your email where I'm highlighting the most important things we'll cover in the video. The big picture is it does look like China's ready to start spending some money in terms of printing, increasing their credit impulse, and trying to boost their stock market. Now, the big picture is China's an absolute disaster. I'll be more than happy to short emerging markets when the time comes. But right now, we have a big picture view where almost every central bank in the world is lowering interest rates and buying up debt, which is taking pressure off the bond market and allowing the banks to flow cash straight into the stock market. It's also allowing the banks to have fresh ammo to loan money to corporations, which is at very low interest rates, and those corporations are turning around and buying back their own stock, which makes the earnings per share go up because there's less shares to spread the earnings with. So this makes their earnings per share look good, and it boosts the liquidity of their stock and pushes it higher. So we're in a world where everything's upside down and backwards, and this can be quite confusing to investors who might look at it just more black and white and logically. Okay, so let's take a look at today's trade. Now, after I took the screenshot, stocks did start to pop up, so all the profits on our long positions in equities will be actually probably at a profit for you right now compared to this trade alert, which was shot about 40 minutes ago. So I do take the trades 30 minutes before we release the alert, and that's how long it takes us to put this whole presentation together. From last Tuesday through today, emerging markets traded down 8 cents, and the option caller protecting the position went from a 4-cent debit to a 1-cent credit for a 3-cent loss. On 3,800 shares, we lost 11 cents for a negative $418 return. But keep in mind, emerging markets has been giving us some huge profits on 11.12. Although we lost $1,700 on 11.5, we picked up $2.3 thousand. 10.29 picked up $798 on 10.22, 1.5K. 10.15 we lost $800, and on 10.8 we'd actually switched out from emerging markets to silver and had a huge $3,738 profit. Now that was expecting the trade deal to break down, but lo and behold, we've got a trade deal, which is what they keep telling us. In terms of our open positions, the SPY did pop up a little bit, so you may be sitting on a profit in this position. We played this very conservatively with a put option at 312. That means if an atomic bomb blew up, let's say North Korea, and we went to war with China, North Korea, Russia, Iran, well, guess what? SPY crashes 10, 20, 30 bucks overnight. Doesn't matter. We're long the 312 put with one contract per 100 shares of the SPY. So we've absolutely locked in this huge run up in the SPY that we've been benefiting from, and now we're just playing it extra conservative. So we're down 22 cents on that position when I took the screenshot, but I close that out tomorrow. So we'll see how that ends up tomorrow. Meanwhile, the TLT has generated a 52-cent profit per share on 3,800 shares, or a gain of $1,976. And GDX, our gold miner ETF, is up 19 cents a share when you account for the change in price of GDX right here, and also reduce what we had to pay for downside protection. So the gold market and the bond market may be at risk to a trade deal coming out for a short-term pullback. The big picture is much more troublesome, so I do want to remain long TLT and GDX and just try to protect any downside risks and volatility with put options and selling call options. But the big picture is these will likely shoot up dramatically higher in the next 2 years. And we'll take a look at why when we cover all the topical content I've collected over the past 12 hours. Here's a breakdown of our return. We're at a negative 2% return in November and picking up profits quickly. It was down 0.5 to start the week out, so that is catching up very quickly as we're getting that bond sell-off to reverse and our strategy is back into full effect, which is primarily to be long equities and bonds at the same time until we get a major financial panic in the markets. And so we'll take a look at two outcomes of what could cause either a bond market to pop or a stock market to pop in our Thursday webinar coming up. It's a 2-hour presentation. It's purely educational. No way I could teach you all of that in today's update. Here's a look at our Monday, Wednesday, Friday SPY trade, up 1.5% in November. And currently, it's just holding the safest asset in that portfolio, the SPY. Now, down below, you can see some of the other assets we could play with if we were in a different period of the market cycle. But this market cycle likely lasts another year to 2 years, so we'll be holding on to the SPY for a considerable amount of time. Now, keep in mind, we also use the options to generate profits to the downside we're just waiting for that catalyst or a sell-off to start for a very short-term pullback in the SPY, which is what we're expecting, and a strong bounce in the TLT. Now, the exact timing can be difficult, but the big picture is we have every central bank in the world lowering interest rates, printing money, supporting their bond market, fueling their government with extra debt, which boosts all the GDP numbers and just keeps this bubble going larger. Emerging markets had a huge return in October, 4%, and so far it's up 0.6% in November. And once again, we realize we're at the end of the business cycle, another year or two left, and we're at very elevated valuations. So we got to play it safe. Instead of owning the exact companies that are predominant in emerging markets, we're holding the ETF, which has 1,000 companies and is extremely diversified. And more importantly, it's extremely liquid in not only the security, but also in the options. So we can not only buy and sell emerging markets very quickly and get in and out, we can also protect that position and generate income from its options market because it's one of the most traded ETFs in the world. The only two that really trump it are the QQQ and the SPY ETF. After that, emerging markets is just flooding with billions of dollars a day. Okay, the bond portfolio went from negative 2.5 to negative 2 this month, and I do suspect it's going to have a strong rally all the way to the election, as there's a lot of trouble ahead. And the big picture in terms of the fiscal policies of the governments plus where we've built our debt levels to is really going to force interest rates to go lower and for all these central banks to continue to prop up their government's debt by buying up this massive deficit that each country continues to pile on with no regard to future generations who have to be paying the interest on this for decades to come. It's really quite a crime, but we got to play the markets how they give it to us. Our precious metals portfolio did jump up today as well. It's had a little bit of a drawdown over the last few months, but again, you can see we've racked up some huge gains in this portfolio earlier in the year. I really think this is just a consolidation period for the precious metals, and we have a tiny bit of cryptocurrencies in our portfolio as well, which have generated large returns as we've gradually gone from a 2.5% position in this portfolio in December to 5% by May, and then up to 10% just recently. So we've been gradually increasing risk in the metals and cryptocurrency market as it's become more clear that the central banks are going to become very dovish and support their government's debts by printing money and lowering interest rates. Okay, so let's take a look at today's trade alert. First step is to close out last Tuesday's trade. If you didn't take last Tuesday's trade, then you can skip this step and go to step 2. But we're going to buy to close the 44.50 call for a penny, and then we're going to sell to close the 42 put. So the net on that was a penny credit. The next step is to sell to open the 44 call for a credit of 11 cents. Now you may get something different. It doesn't matter. Stick to the strikes and the expiration. You're going to get very close results to what I'm producing. Because if this emerging market goes up 10, 20 cents, you're going to get a fair price on the options and you'll get a better profit on the emerging markets. And on my side, I may make a little less profit on the emerging markets, but pay a little extra on the option caller. So it really nets out to be the same result with very little differential. Now again, we're taking very little risk in case the trade war does escalate, which I do think will happen before December 15th, which is the deadline. But if we keep getting these little leaks that they're talking and things are hopeful, I do suspect the markets will continue to buoy up slowly and gradually. So we do need the EEM to go up to above 44 to hit our maximum profit, which is just over 1% on this trade. So $64 maximum profit with a $36 maximum loss. And if it just trades flat, we won't make a profit. We need it to actually go up by about 85 cents to hit our maximum gain. Okay, let's move into the topical news of the week, or of the last 12 hours. So this is just a funny graphic. Before QE, after QE4. Here's what is amazing. Global liquidity proxy is extremely tied to stocks. So the second these central banks try to vacuum money out of the economy and raise interest rates, stock market crashes. Second, they start to print money and lower interest rates, stocks go up. You get that big picture right, your life's going to be so much easier at predicting markets. And then you tie in the bond market with the equity market, and you're going to make a very bulletproof portfolio that's extremely hard to lose money. Add on top of that are option callers, and you are way, way beyond the crowd. Here's the percentage of central banks easing, and so we're at above half, and this includes all major central banks from Europe, America, and China. Really the only three that are critical for us to evaluate what's happening. Now, China was kind of dragging their feet. They've gone way out of their way to print a ton of money. They have about 10 times the money supply as us, but they have half the GDP, if you trust their numbers. And that GDP has really built a whole bunch of things that aren't being used. Primarily, they've got some 10 cities the size of New York that no one inhabits, and they've got 65 million houses that are just concrete shells that no one lives in, that are just crumbling away. So I do suspect their GDP will continue to crash and take the rest of the world down with it. So think of World War I, when all the countries were punishing Germany at the same time, and their economy collapsed. They had hyperinflation, their currency blew out, they started inventing new currencies to try to save the day. But at the end of the day, it just didn't work out. We went into the Great Depression. So that's what Ray Dalio is predicting will happen in our lifetime, and that we're in the 7th inning of the baseball game, and so we're getting near the end of the rope. And in our presentation on Thursday, I'll show you where the end of that rope is. It's no big secret, and it's quite obvious when we'll get near that moment in time. Okay, so Bank of China injects 120 billion yuan into the open market, so divide that by 7. You got about $20 billion. That's a lot less than America's doing with its repo markets, which is something like 60 billion overnight. But we also have 3 different schedules of repo markets that total around $180 billion. So we're doing a lot more easing than they are, which explains why our stock market is at nose-bleeding all-time highs, and theirs is still struggling to get back to that high in 2017, where it hit 52 on emerging markets. Right now it's at 43. So we have about a 7.5% return just to get to the most recent high. Now, the only way I see that happening is if they do continue to increase their credit supply and we roll back tariffs and have a period of easing in the trade war. Very questionable if that will happen. That's why I'm paying a premium for a put option below and just playing it safe. So we're going to give up probably about half of all profits on the equity side here on out until we get a significant sell-off, and then I'll feel safe using a little less conservative option callers. Meanwhile, we're waiting for the TLT to rocket higher with GDX in the next series of bad news. Now, the good news is that we're actually seeing TLT and GDX go up, and there isn't any bad news. So clearly, this is playing out very well for our portfolio. Here's from the long view. Trump seems to suggest he can use the money from tariffs and economic strength from tax cuts to help maintain the trade war if China doesn't want a deal. So this weekend he came out saying there's a big round of farm bailouts coming from the tariffs. This is the signal that Trump is ready to raise tariffs December 15th to show he does mean business. So we have 26 days until that date, approximately, for a trade deal to be struck. Otherwise, there's going to be some chaos in the equities market and quite likely a strong jump in the bond market. Plus, on top of that, we have the next Fed meeting coming up December 11th through the 12th, where we have the opportunity for Trump to try to get another rate cut and to really ramp up QE, which we know he wants, as he's publicly displaying this on every single media chance he gets. Plus, he had Powell come to his office with Mnuchin to discuss this. So right now, they're remaining data dependent. What would get them to act? Probably some more trade war uncertainty and escalation. So I think there's a high probability that Trump goes forward with those December 15th tariffs and maybe even threatens more. And so here's some quotes. One of the things I was able to do with China as an example, we've taken in, we'll soon be up to $100 billion in tariffs, and you haven't seen inflation, you haven't seen, in many cases, price increases. Our farmers, because I have a very good relationship with our farmers, our great American farmers, I call them patriots, they were hurt very badly by China because China targeted them because they were my vote. The whole middle of the country, it's a beautiful thing to see, I will say, but they targeted them. And I said to Sonny Perdue, our Secretary of Agriculture, Sonny, how much is it? He said, the year before last it was $12 billion, and this year it's $16 billion in orders. I said, that's okay, Sonny. We're going to give them $28 billion. We're going to take it right out of the tariffs, and hopefully the farmers will say, thank you very much, China. And we distributed 2 years, $28 billion around from China into our farmers and farms and ranchers and all of the people that were targeted. So I would say in a rough manner by China, I would say in a very rough manner. And now China is coming back. Okay, so very interesting translation there. Bottom line, the big farmers got the bailout the first round. Little farmers are going bankruptcy at an alarming rate, a 25% increase year over year. So now they're doing a new bailout to small-time farmers, which does show me that, and here's another highlight, if we don't make a deal, we're going to substantially raise those tariffs. They're going to be raised very substantially. So this is alarming, and the countdown is ticking. Okay, so meanwhile, China's reserves of dollars and treasuries is losing value quickly. In fact, they've spent around $1 trillion of either U.S. dollars that they held in their reserve when you add it in on top of their U.S. treasuries. So they're running out of cash quickly trying to keep this boat afloat in China, and they're having banks go bankrupt left and right. And they're having construction companies go bankrupt left and right. Plus, they're not allowing anyone to sell their real estate unless it's at extremely high valuations. So no one wants to buy it. They're huge skyscrapers, and even their biggest cities are barely filled with anyone at all. So it's really quite a disaster in China. And we're really just playing the final months, maybe years of this bubble melt up before we get to the end of the rope where central banks cannot keep pumping more money and bubbling up these different asset classes. China doesn't want December tariffs, but calculation Trump might not do them because of Christmas and potential harm for the U.S. economy. U.S. suppliers here say tariff would impact 2020 pricing. Only some local factories split cost. New contracts have tariff charge, and this disappears if the U.S. lifts the tariffs. In fact, China wants them to roll back the tariffs. And the mood in Beijing about a trade deal is pessimistic, government source says. This is from Bloomberg. I'm trying to get a feel for what Michael Bloomberg's political views will be on China. We know they've created index products that have funneled billions of dollars into China, and that China spends a ton of money buying advertising and services from Bloomberg, and now he's running for president. So we have Joe Biden, Michael Bloomberg, who may be pro-China, and perhaps if the Chinese do believe, if they put as much pressure on Trump as possible and push us into a recession, they might be able to get him out of the office. So that's a risky bet as their economy is slowing down rapidly, and they're having bankruptcies left and right. So now they're trying to pull the good money out of companies like Alibaba and all these successful companies and to use those profits to subsidize the industries that are losing. So it's difficult to keep 1.4 billion people with work, especially when you're in a trade war. So far, the commentary out of Bloomberg's been somewhat in the middle, so I haven't had a good feeling for either way. Meanwhile, the Hong Kong siege and drama continues, and meanwhile, Alibaba is about to, or I think they just did, do a IPO in the Hong Kong exchange. Now, if Hong Kong's in a massive war with China in terms of their democracy. Their GDP is crashing. One person's been killed so far. Lots of bodies have been found in the ocean. It's heating up. So this is very troublesome, and another reason I want to be long the TLT and GDX, and then conservatively long our equities positions. Hong Kong Chief Executive Carrie Lam told police she hopes the campus standoff can be solved peacefully. There's some 100 people, I believe, still stuck in there. And the prison sentence for what they're doing is something like 10 years. Imagine protesting your government, you end up in jail for 10 years. Bank of Japan. I never said Bank of Japan can cut rates unlimited, and that Bank of Japan has unlimited ammunition to ease. Very few at the Bank of Japan believe they cannot deepen negative rates beyond negative 0.1. So Japan's been doing some very interesting monetary policy, and it looks like all the major countries are headed into the same boat that Bank of Japan is, where you essentially have your central bank buy up all asset classes. You never let anything fail. You stop having growth altogether, and it really changes your economic situation. Now, we've seen Bank of Japan, or rather Japan, lose its lead as the second most powerful country in the world quite rapidly from this policy, as China took second place. Really over the last 10 years they did this. But for them to start talking about going below negative 0.10% does start to allude that potentially America could go below the zero bound, which helps us with figuring out the timing of when the bond market pops. So that's really where the end of the rope is somewhere around 0%. Bank of Japan, we will continue with powerful monetary easing. We'll weigh the costs and benefits of easing. Now, they own 60% of all their equities, and they're probably the single biggest buyer of U.S. stocks currently. Meanwhile, as all the central banks are printing away, they're gobbling up gold at record pace. And this is why we want to be long the GDX ETF, even if there's bits of volatility. And Japan has quite a bit of treasuries as well, the number one holder now. And this is as Russia and China have stopped purchasing dollars. They're letting their reserves wind down, and they have been for the last 10 years trying to get the world to get off the dollar standard. And so that is probably what the biggest part of this war is a currency war. But other countries are picking up the slack, and primarily that's because they have so much debt denominated in dollars that they need to pick up treasuries, earn some interest, and use that to pay off their interest in the bonds they've sold. So we are seeing Luxembourg, which is really just kind of a hideaway country for big money to hide their assets. Israel skyrocketing up in terms of U.S. Treasury purchases. Now here's an interesting chart. This has been pitched for at least a decade now that U.S. market's going to have losses for the next decade while emerging markets has all this value. But when you look at the underlying problems of China, that's a hard sell. So I'm not quite sure I believe this, but people like Jeffrey Gundlach, Ray Dalio, Druckenmiller, all of them, all these big, huge $100 billion funds are all pushing this narrative that you need to be long emerging markets. BlackRock, $1 trillion asset group. And we've also seen more money flow into emerging markets than U.S. markets, despite this discrepancy where emerging markets continue to slack and U.S. stocks go higher and higher on super low liquidity. Here's a look at Japanese economy, where there's no growth for the last 2 decades, just going flat, going nowhere really quickly. They have a huge demographic problem. President Xi, the extreme violent offenses in Hong Kong have trampled on the rule of law and disrupted public order, severely undermined the prosperity and stability and challenge the principled bottom line of one country, two systems. And plus, you get all the Muslims in China getting word of this. They're all going to be trying to break out and riot. So this is their biggest concern, is losing control of the narrative and losing control of the mainland. This is back in 2009. China calls for a new reserve currency. China's central bank on Monday proposed replacing the U.S. dollar as the international reserve currency with a new global system controlled by the IMF. So they've been wanting to do this for quite some time. Of course, this is what allows the U.S. to fund its debts at ultra low rates and have so much power in the world. Plus, we force most of the oil to be bought and sold in dollars, which forces everyone to make our dollar the reserve currency of the world. Here's a chart of emerging markets against SPY, just showing you that huge divergence, which is definitely alarming. And emerging markets has acted as somewhat of a leading indicator this year for equities. We have seen them break paths in the past, but with this whole notion that we have a trade deal ahead, they should be correlated. And so that correlation has been a little weak lately, although last month it was very in tune and we picked up a nice 4% return on emerging markets. U.S. extends new 90-day license for firms doing business with China. Huawei move comes before this week vote at the FCC at Huawei should be designated a national security risk. Washington today, the Bureau of Industry of Security, BIS, and the U.S. Department of Commerce announced that it will extend the 90 days of temporary general licenses. If you get into it, it's to allow carriers to continue to service customers in some of the most remote areas of the United States who would otherwise be left in the dark. The department will continue to rigorously monitor sensitive technology exports to ensure that our innovations are not harnessed by those who would threaten our national security. Hong Kong anti-mask law ruled unconstitutional by High Court. So this was a win for the people, saying it's unconstitutional to not allow them to wear masks to hide their identity. And of course, China hates that. They've got the best technology in the world. It can scan crowds of 1,000 people and identify them all simultaneously in a split second. So that's one technology. They're way ahead of the rest of the world, and they're putting it to full use in China. China's debt bubble is insane. It's huge, but it's mostly denominated in their own currency. So just understanding the sheer size of their debt will help you understand why we want to short their currency, and probably quite soon. So for you boot camp customers, do expect us to start legging into a short Chinese position as we get closer to the tariff date. Without some considerably good news on the trade war front, I'm almost ready to pull the first trigger on Friday. So we'll see. At my meeting with Jay Powell this morning, I protested the fact that our Fed rate is set too high relative to interest rates of other competing countries. In fact, our rates should be lower than all others. We are the U.S., too strong a dollar hurting manufacturers and growth. J.P. Morgan shames Jeffrey Gundlach, the king of the Armageddonists. And so sure, Jeffrey Gundlach definitely promotes doom and gloom to raise capital for his fund. Last 2 years, he was extremely accurate with his predictions. This year, not so much. He was short the TLT and long emerging markets. And so far, both of those have been a huge disappointment. But I do pay close attention as he is the bond king. Okay, we looked at that chart already. Everybody's been pitching this value versus momentum, and we're at a record divergence in value versus momentum. It started to have a bounce over the last week or so and then just completely broke apart, and your Apples and Microsoft soared up to new highs. So we're seeing the top companies do really well, and that's primarily because they have access to cheap capital to borrow and buy back their own stock. And so that trend will most likely continue until the Fed starts to hike interest rates, which would totally collapse the whole credit market, which is why I don't think they will. We want to continue being long the TLT as well as the stock market. Treasury issued, okay, so all this is pointing out is the Fed is not supposed to buy government debt directly. They're supposed to buy old debt from primary dealers in the open market. But this guy is just pointing out that they're buying treasuries that are now days and weeks old from the banks. This means the bank has some sort of hush-hush deal with the Fed that you buy it, we'll flip it to you for a profit. And so it's a guaranteed profit for these banks. It's an absolute crime and should be stopped, but good luck with that. Now, this is an interesting chart. This is similar to our strategy that's become pretty famous over the years, the 60-40 portfolio, 60% equities, 40% bonds. Just shows you how well, if you just mindlessly hold those two, that it dramatically reduced your maximum drawdown. Now, our strategy is more advanced than that. We have option callers on top of it, so our drawdown aim is to never lose more than 1% in a month. And so far, we've been quite good at doing that despite considerable volatility. And in fact, we're actually picking up profits rather than losses when equities pull back. So I would say our strategy is a lot more advanced and lucrative than this, but it does show you just the basic idea that the bonds will bail you out when stocks puke and sell off rapidly. The stock market has canceled the recession. The bond market has not. In fact, there really hasn't been much improvement at all. Curves aren't so much decompressed as they just stopped compressing. So he's just noting that we're seeing the TLT and SPY go up together as the bond market still sees trouble ahead. And Powell meets Trump Mnuchin to discuss economy in a rare sit-down. We covered that. Horseman was up for a little bit last year, and now he has lost a fortune, and 75% of his assets have left. And so that's what you get when you try to short the market too early. Massive losses. He's down 27% for the year, 6% for the month, and his year return last year was only 7.5%. This is just comparing the 10-year yield to the S&P 500, and it would indicate that we have a reversion coming in, that yields should go down and stocks should sell off. Now we get a trade deal that, of course, could be incorrect. JP Morgan's Kolanovic says the market can easily absorb another 150 basis points of the 10-year yield before we get a sell-off. Remember, in 2018, it's when the 10-year hit 3% that the stock sell-off began. From a bank standpoint, if they can get a guaranteed 1% against 2% inflation, so 3% yield per year, 2% expected inflation, they're going to leverage the hell out of that and take every penny they have to buy that up for a guaranteed profit. So you see stocks have trouble when the bond market's yield gets too attractive. So he's just saying this stock market's going to go up considerably before we get any kind of action like that. Nordea takes the other side and warns that just a 35 basis point rate rise may be enough to trigger a 10% correction. Okay, so we can see the stock market's earnings are way below the price tag on stocks, so they're expecting a trade deal to come. And if that came, maybe that's a fair valuation. That's really looking way down the road. Because right now, all the earnings estimates are coming in with lower guidance. Earnings growth has actually hit a negative 5% for the first time this year. And so the clear picture is everything is slowing down. Our GDP for Q4 is expected to be below 1%. So it's really just pure market manipulation by the central banks and corporate buybacks at this point. Fed's Mester says that we have a well-calibrated economy, basically on hold, watching how the economy develops. Preferred not to cut rates at last meeting. Sympathetic to the view that the last rate cuts made sense, was a close call. Negative rates are working in Europe, he says. Well, that's a bunch of baloney. Look at Deutsche Bank. That bank has lost 90%. We're going to see some people rioting because their pension has cuts because they can't earn any interest on all the money in the pension fund. And so now it's forcing pension funds to take on risky equities. It's all madness. Equities are pricing in a strong rebound in PMIs, but yet the PMIs are crashing. Now we're over to the political section of our updates. Nancy Pelosi just stated that it is dangerous to let the voters decide Trump's fate. In other words, she thinks I'm going to win and doesn't want to take a chance on letting the voters decide. Like Al Green, she wants to change our voting system. Wow, she's crazy. Elizabeth Warren, millions of Americans are spending more than 30% of their income on rent. This is the big picture of what's going on around the world while we have populist revolts everywhere, from Hong Kong to Lebanon to Italy to France. This is the big problem. Central bankers have increased asset valuations, making rent too expensive. They've taken that out of the CPI, which would force them to raise rates. And so now we got a whole bunch of poor people who can't afford their rent, and they're pissed. This is when governments make dramatic changes. And so maybe it doesn't happen this election, but if this continues, and it looks like it will, you're going to have some sort of Elizabeth Warren type come in and dramatically change the way the economic system works in America. And this is happening all around the world, not just in America. In 2012, French socialist Pres Holland imposed a 75% tax on millionaires. What happened next? 10,000 millionaires fled the country. Real estate prices and capex collapsed. Budget deficits soared. GDP did not print above 0.8 for 2 years. And the tax was overturned in 2015. Netherlands headed for unprecedented crisis. Millions of retirees face pension cuts thanks to the ECB, and that's their negative interest rates. You can't earn interest with your money in the bank for the safe income we need to fund the pensions. Interest rates really need to be up around 5%. That's the 200-year average. That's where it makes sense. You don't borrow unless you're going to make a profit, and you don't have malinvestment. Speaker Nancy Pelosi invited U.S. President Trump to testify in the House's impeachment inquiry. Trump said he'd strongly consider it. 8 more witnesses are scheduled to appear in public hearings this week, including several who were on the now famous call in which Trump urged Ukrainian President Zelensky to investigate ex-Vice President Joe Biden and publicize that he was doing so. Nancy Pelosi, last week's witnesses confirmed President Trump traded away our national interest for his personal political interest. This is why we must defend our democracy. This seems like it's losing a lot of steam quickly. The stock market doesn't seem to care. We'll see if they actually go for a vote, and if so, what happens in the Senate. At this point, I'm paying less and less attention to it. Steve Bannon does have a 2-time-a-day podcast where they're summarizing what's going on. So I do listen to that for a summary. Meanwhile, Kanye is going to run for president in 2024, and he's gone hardcore Christian. He's got a huge following. This is interesting. I'm just looking at general themes in America, and so this was definitely something very interesting and odd that's happening, and really gaining pace. U.S. Senate Majority Leader McConnell, President is willing to sign a stopgap funding bill through December 20th to avoid partial shutdowns at the end of this week. Now we're looking at our charts. Here's your SPY ETF. Remember, we were calling for 315 SPY about a month and a half ago, right after that Phase 1 trade deal announcement came. And now we're $3 away from that target. With a Phase 1 deal, my new target's 330. But I don't think we're going to get that trade deal. Now, we're not playing it until we get that as a matter of fact or a catalyst or a strong sell-off. We're still remaining constructive and bullish on equities, although we're playing it very safe. Same thing is true for emerging markets. GDX, I think, can break the 2010 high easily because the amount of debt is multiplied, not by a factor of 2. It's multiplied by a factor of almost 10. So when the money escapes from the stock and bond market, it's going to find its way into gold, probably into commodities. So this has a lot of room to run here. LQD is your investment grade corporate bond ETF. The second the Fed starts to hike rates, this thing is going to crash so fast, and then all of a sudden your corporate buyback scheme is broke. So we're keeping a close eye on this for it to show signs of weakness. So far, it's at near all-time highs, meaning the corporate buyback scheme is in full strength. 20 times the money printed as the US with 1/2 the GDP. That's what China's done. You understand that, and you understand this conversion rate must travel higher. They cannot support the currency. So this will be a good play probably for the next decade. Every time you get a good sell-off, you want to short the currency. This is something we're doing for our boot camp members exclusively. I'm about ready to pull the trigger. The only catch is that if they do roll back tariffs, I could see this strengthen maybe back to the 6.7 level. So I've been hesitant and waiting to pull the trigger on this. Gold, again, central banks are buying it up at record pace as they print money at record pace. So pretty simple. Unless we think the GDP is going to grow at a faster rate than the debt and the central banks are going to stop cutting rates and start hiking rates, we want to be long gold. So simple to understand that. Crude, my only concern is if it goes too far below 60, that shows a very weak economy. And we want to go bearish on our stock portfolio and more bullish on our bonds. On the same note, if oil gets too expensive, we want to be strong in the equity portfolio and bearish in the bond portfolio because that'll indicate inflation is coming in, and that is what forces the Fed to finally at least stop cutting rates and maybe even start talking about raising rates. The German 30-year bond is the best leading indicator of the bond market. You can see it's in a clear downtrend. This is a little dead cat bounce. Its biggest trading partner is China, and China is really doomed. The best case for China is to try to get all the malinvestment out of their economy, stop building projects that are a big waste of money, and to try to just stabilize their GDP. Probably realistically, they may go negative for quite some time and then bounce up at a fair value and have growth that's more similar to the US, around 1 to 2%. And here's your German or your US 30-year yield, and you can see the very similar pattern of the German bond, which is really the best leading indicator for us. So my expectation is these yields will go much lower, and right now the spread on the federal funds rate and this rate is about 50 basis points. So this could potentially go to 0.5 yield, and that might be the bottom of the rope if we assume a 0% interest rate is as low as the Fed would go. Now, if the Fed starts hinting they might try some negative yielding interest rates, then maybe it goes even lower. But for now, we have quite another run up in the TLT before we get close to that. Meanwhile, with all the moves of the Fed, you think the dollar would be weakening, but no, it's at 97.83 and near all-time highs. So sure, we have seen it get as high as 120, but right now it's at a very high rate. This just indicates that the rest of the world is having a hard time servicing their dollar-denominated debt, so they're forced to print new money, convert it into dollars, and use that to pay the interest, and so that drives up the value of the dollar. Meanwhile, crypto's still having a little bit of a slag, but I still remain bullish on cryptocurrencies. This is only 2% of our total portfolio, and so we got in at 3,500 on Bitcoin and something like 45 on Ethereum back in December when they had crashed 90%, almost 90%. So we've had a great run up. We've been taking profits and keeping our total risk at below 2% in this portfolio, and it has generated a lot of profits in the first half of the year. The second half of the year, alongside gold, it's been pretty weak, but I think it's just a pause. We've got 3 ingredients to be long gold and crypto. Number 1, are the banks lowering rates? Check mark, yes. Number 2, are they printing money to support their government's debt? Check mark, yes, absolutely. The last ingredient is throw in some fear, and then people rush into these assets. And so I do think some panic and fear is headed our way. Just think, we've got the 2020 election, and we've got a president who's trying to completely disrupt the global order and trade routes. He's pissing off a whole lot of people. So there's good reason to be long these assets. All right, guys, that's a wrap for today's presentation. I really appreciate everyone. Thanks for saying hello in the chat box, Ron. Tomorrow we'll close out that SPY trade. We have our paid member only webinar. Thursday is a sneak peek at our $10,000 boot camp, purely educational. Really recommend anyone who hasn't joined our program to join in, and I'll show you how to predict how these two markets pop, the stock market and the bond market. It's not that difficult. Once you see the charts, once you see how it all lines up, you'll be able to predict this just as well as I can. All right, thank you so much.